Want to understand Warren Buffett's investment strategy?
Oh, you've come to the right place.
We're going deep into his 1982 letter.
To Berkshire Hathaway shareholders.
And this thing.
It's packed with insights that are still relevant.
Eve today.
It's true. This letter's like a time capsule of wisdom.
Yeah, it's basically a masterclass in business.
And investing.
Straight from the Oracle of Omaha himself.
What strikes me is how his core principles about business value
And smart investing?
haven't aged a day,
Not one bit.
even in today's crazy market.
So, before we get lost in the brilliance,
Quick reminder,
Berkshire Hathaway's shareholder letters.
they're not.
Not your typical corporate jargon.
No.
Imagine getting a personal letter from Buffett.
Breaking down his investment moves
Market observation.
and what he's learned.
That's what these letters are like.
Exactly. And this one
This one in particular hits on some key themes that any investor,
should care about.
from how to think about a company's true earnings,
To why Buffett prefers buying
entire businesses.
rather than just a small slice.
And let's not forget his warnings about getting caught up in market hype
And why understanding an industry's ins and outs.
is crucial.
Oh, and he absolutely slams the brakes.
On the idea of issuing stock to make acquisitions when your company's undervalued,
Buckle up.
we're about to unpack a lot.
Let's dive in.
Okay, right off the bat,
Buffett focuses on this idea.
of economic earnings versus accounting earnings.
He's clearly passionate about this distinction.
It's like he's saying, don't just look at the numbers on the surface
Understand the real earning power.
of a business.
And he's got a good point.
Yeah,
Imagine a company is like a cash machine.
right.
It's churning out profits.
Okay,
Now they can choose to pay all that money out as dividends.
which is what shows up as your accounting earnings.
Your cut of the payout.
Right. But what if they decide to reinvest those profits?
To grow the business even more,
That's where economic earnings come in.
they consider the entire cash flow,
So it's like looking under the hood,
revealing the true potential of that cash machine.
even if you're not seeing all the cash right now.
Exactly.
And Buffett uses Geico.
As an example in the letter,
Back then, Berkshire owned 35% of Geico.
if Geico earned a ton but decided to reinvest it instead of paying dividends,
Berkshire's reported earnings wouldn't change.
but the value of their Geico stake,
It would absolutely skyrocket.
that makes a lot of sense.
It's like saying the value of your house can go up even if you're not renting it out.
Precisely.
Okay.
And this is a crucial concept for you.
Because it encourages you to look beyond the surface.
Don't just get fixated on the reported earnings.
Think, is this company reinvesting wisely?
Are they building something?
That'll be worth even more in the future,
Now that brings us to acquisitions.
which Buffett clearly sees as a core part of Berkshire's strategy.
And he's very specific about what he wants.
100% ownership,
Of great businesses.
not just a piece of the pie.
You could say he wants total control.
No boardroom battles, no conflicting visions.
He wants to steer the ship his way.
Implement a long-term vision without having to answer to other shareholders.
Who might have different ideas.
But finding those perfectly priced, well-run businesses that are also up for grabs.
That can't be easy.
It's got to be like finding a unicorn.
Well, he certainly makes it sound challenging.
Yeah.
He even mentions an almost deal that fell through in 1982,
Oh, really?
which in retrospect he's relieved about.
Hmm.
It seems dodging that bullet saved Berkshire
From potentially wasting time.
and resources on a deal that wasn't quite right.
So even the Oracle of Omaha doesn't win every time.
Absolutely.
That's reassuring in a way.
And what's interesting is he doesn't frame it as a loss. He
Oh.
sees it as a win
For patience.
and discipline.
Speaking of patience,
Buffett spends a good chunk of this letter
warning us
about the dangers of getting swept up.
in stock market hype.
He's basically saying,
Don't just chase the hot stock of the day
focus on the fundamentals.
and long-term value.
He uses a great analogy.
Oh, yeah.
Imagine paying an outrageous price for a fantastic farm.
Okay.
The farm might be amazing.
That's-
You've overpaid.
And it'll take you years to recoup your investment.
Buffett sees market fluctuations as opportunities.
When everyone else is panicking and selling,
He's looking for those diamonds in the rough.
great companies that are temporarily undervalued.
So when everyone else is zigzagging,
He's playing the long game.
that makes sense.
It's easier said than done, right?
Yeah.
How do you stay focused when the market's going wild?
He actually addresses that in the letter.
Does he?
He talks about how back in 1972, Berkshire had very limited equity holdings because the market was in a two-tier market mania.
What is that?
Prices were inflated, and he refused to play that game.
Okay.
His discipline kept him from making some potentially disastrous investments.
It's like that saying, Sometimes the best investment is not investing.
Exactly.
It's about having the conviction to stick to your principles, even when everyone else seems to be getting rich quick.
Now, this next part is where it gets really interesting for me.
Right.
Buffett goes deep.
On the insurance industry.
Which, let me tell you,
Was a wild ride back in 1982.
it was facing a classic problem.
Overcapacity.
Imagine a ton of restaurants all trying to sell the exact same burger.
Okay, I gotcha.
It becomes a race to the bottom.
With everyone slashing prices just to survive.
So it becomes less about the quality of the burger,
And more about who can offer the cheapest price.
which probably means thinner patties.
And less tasty toppings.
Exactly.
And that's what was happening.
In the insurance industry,
Too many players.
all selling basically the same product.
It led to intense competition and a squeeze on profitability.
But why was it so easy for new companies to jump into the insurance game?
I don't know why.
Historically, insurance companies maintained profitability through
A kind of semi-regulated pricing system.
regulators had a say in setting rates.
So it wasn't a complete free-for-all.
But in the 80s, that started to change. New players entered the market,
Ignored the old rules.
undercutting prices and disrupting the established order.
It's like the Wild West of insurance.
And what did Buffett make of all this?
Yeah, what did he think?
He saw it as a sign of things to come.
Oh.
He realized the old ways of doing business were changing
Right.
and that companies would need to adapt.
Or die.
This section of the letter is like a case study
In understanding how an industry can transform.
and how important it is to analyze those dynamics.
It makes you realize that investing isn't just about picking companies
It's about understanding the forces.
that shape entire industries.
Absolutely. What are the barriers to entry?
What are the key drivers of profitability?
How easy is it for new players to shake things up?
These are the questions Buffett was asking.
And they're just as relevant today.
Okay, before we get too deep into the weeds here,
Let's move on.
to a topic that clearly gets under Buffett's skin.
Issuing stock when it's trading below its intrinsic value.
It's like he sees this as the ultimate betrayal of shareholders.
He does not mince words here.
Oh no.
He sees it as a direct transfer of wealth from existing shareholders to the new shareholders.
From the old to the new.
Imagine you own a piece of a valuable pie.
Oh.
The company decides to issue more shares
Creating more pieces.
of that same pie.
So now your slice is smaller.
And it's worth less.
And he uses a great analogy.
To drive this point home,
Yeah, what's that?
imagine merging your 120-acre farm with your neighbor's 60-acre farm,
Okay.
but you give away half the ownership in the process.
So you own more land overall.
But your proportional share is smaller.
It's a brilliant way to illustrate how dilution works.
And what makes it even worse
What's that?
is that it often signals a lack of confidence from management.
Interesting.
It's like they're saying, we need to raise money, but we don't believe our stock is worth what it should be.
So it's not just about the financial mechanics of dilution, it's about the message it sends to the market.
Exact.
And that can have a lasting impact.
on the company's valuation.
It's a double whammy.
You lose value through the transaction itself.
And then the market punishes you further for making a bad decision.
It's a stark reminder
That capital allocation decisions matter.
they can either create value,
Or destroy it.
and savvy investors pay close attention to how companies use their shareholders' money.
It all comes down to trust.
Are these managers stewards of your capital?
Are they making decisions that benefit you as a shareholder?
Those are the questions you should be asking
Okay, we've covered a lot of ground here.
in part one.
We've talked about economic earnings,
Acquisitions,
market hype,
the insurance industry.
and the dangers of stock dilution.
Believe it or not, there's still much more to unpack from this letter.
I believe it.
Stay tuned for part two, where we'll delve deeper into Buffett's insights on corporate performance
Finding great managers.
and the importance of long-term thinking.
Welcome back
We're continuing our deep dive
into Warren Buffett's 1982 letter.
to Berkshire Hathaway shareholders.
And in this section,
He gets really candid about performance.
both good and bad.
It's refreshing, actually. He
Yeah.
doesn't shy away from admitting that.
1982.
Wasn't Berkshire's best year.
Right. It wasn't all sunshine and roses,
He points to a few factors
including those tough conditions in the insurance industry.
we talked about earlier, the
Oh.
whole too many restaurants selling the same burger problem.
He acknowledges that insurance underwriting wasn't exactly a cash cow at the time.
But what I found interesting
What's that?
was his reaction.
He doesn't freak out.
No, he doesn't.
Instead, he sees opportunity.
He actually says, and I'm quoting here,
Okay.
if the businesses continue to look attractive and we have cash available, we simply will add to our holdings at even more favorable prices. He's basically doubling down.
When others might be running for the hills.
That's classic Buffett, though, isn't it?
He's the ultimate contrarian.
When everyone else is panicking.
He's thinking, time to buy.
But how does he stay so level-headed?
Yeah.
Well, it comes down to his long-term perspective.
He's not playing the short game.
He's building a portfolio.
For the decades to come.
And that brings us to one of the most engaging parts of the letter.
What's that?
His discussion of Geico.
Oh, yeah.
He clearly has a soft spot for Geico.
You could tell.
He spends a good amount of time
Praising their management team.
especially Jack Byrne and Bill Snyder.
He admires their efficiency.
Their focus on delivering value
Their customers.
and their ability to...
keep things simple.
He even jokes that their corporate creed should be, let Jack do it.
It's fascinating how he connects good management with good investment.
It's not just about the numbers.
It's about the people running the show.
Exactly.
He trusts the people at Geico,
To make smart decisions.
which is why he's so confident in their long-term success.
And this leads to a broader point he emphasizes.
Aligning yourself.
With great managers.
He believes you should look for companies with strong leadership already in place.
Because he can't be involved
In every single decision.
at every company Berkshire owns.
Right. He needs to trust that those at the helm are making the right calls.
Precisely.
It's like delegating on a massive scale.
Find managers who are skilled, ethical,
And share your
for
vision.
the company.
And then let them do their thing.
Speaking of vision,
Let's talk about how Buffett views shareholder value.
he dedicates a whole section.
See, this idea of not destroying value.
It gets pretty intense.
When he tackles issuing
He
equity
uses some colorful language,
to describe this practice,
especially when companies issue stock below its true worth.
he compares it to,
Exchanging dollar bills for 50-cent pieces?
which no one in their right mind would do.
So he's saying, why would you sell your company's stock for less than it's actually worth?
It's like giving away value for free.
And he systematically dismantles the justifications you often hear for doing this. Like, the company we're buying is going to be worth a lot more in the future.
Right. But don't companies need to issue stock sometimes?
To raise capital for growth.
He addresses that too.
He's not fundamentally against issuing stock, but
It has to be done.
at a fair price.
He's adamant that Berkshire will not issue shares unless they receive at least as much intrinsic business value as they give up.
It's about a fair exchange
Not diluting the value.
with existing shareholders.
He even points out how the language used in mergers,
Can be misleading.
instead of company A to acquire company B,
He suggests a more accurate description.
would be part of A sold to acquire B,
It reframes the whole transaction.
highlighting that something valuable.
Is being given up.
It's a subtle point.
But it makes you think differently about acquisitions.
Are you truly gaining something
Or are you just giving away a piece of yourself?
for something that might not be worth it?
In the long run,
It's a reminder that every deal,
has a cost.
and it's essential to evaluate whether that cost is justified.
Okay, let's shift gears a bit.
And talk about one of Buffett's core principles.
Long-term thinking.
This is a theme he weaves throughout the entire letter.
He's constantly emphasizing the importance of looking beyond the next quarter. Or even the next year.
He wants to own businesses that will thrive,
For decades.
not just make a quick buck.
And that philosophy influences everything.
From his acquisitions,
To his views on repurchasing shares.
he actually talks about buybacks
As a way to undo the damage.
caused by previous bad acquisitions
It's like admitting a mistake.
and trying to fix it.
He compares it to recovering a fumble.
In football,
It's not as glamorous as scoring a touchdown.
but it's still a crucial part of the game.
It's a humbling reminder that even the best investors make mistakes.
But it's how you respond to those mistakes.
That matters.
And sometimes the best move is to simply do nothing.
Let the power of compounding work its magic.
Which brings us to one of the most thought-provoking sections of the letter.
His discussion of what he calls
The double whammy effect.
of value-diluting stock issuances.
He's talking about how when a company issues stock below its true value,
It doesn't just lose value in that immediate transaction
it also suffers a long-term hit.
to its reputation.
It's like a breach of trust.
Once management shows they're willing to dilute shareholder value,
The market takes notice.
they demand a discount, a safety margin.
To account for the increased risk that management might do it again.
Oh, it's not just a one-time hit.
It's like a stain on the company's record.
That can linger for years.
It makes you realize that building a strong reputation
For shareholder-friendly decisions,
is invaluable.
it's about more than just the numbers.
It's about building trust.
Throughout this letter,
Buffett drops these little nuggets of wisdom
about the qualities he admires,
in managers
he values integrity, competence.
and a deep understanding of the business.
He even shares anecdotes about specific managers who impressed him,
Oh, like who?
like Phil Leach from National Indemnity Company,
Eh.
Ben Rosner from Associated Retail Stores.
Okay.
He praises their dedication, integrity,
And how they ran their businesses as if they owned 100%
and it's clear that he sees these qualities as essential.
for long-term success.
It's not just about being smart.
It's about having the right character.
He basically says that if Berkshire can continue to attract managers like Phil and Ben,
The company will be in good hands
it's a testament to how much he values people.
over spreadsheets.
Now, before we move on to the final part of our deep dive,
I want to touch on something that really struck me in this section
Buffett's discussion of the competitive landscape.
of business
He uses the example of sugar.
to illustrate how, in some industries,
Differentiation is fleeting.
he points out that no one really cares what brand of sugar
They're using.
in their coffee.
It's a commodity.
And when you're selling a commodity,
The only way to win is to be the low-cost producer.
which sounds like a recipe
For razor-thin margins and a constant battle.
for market share,
It can be.
and it makes you think differently about what makes a company truly great.
It's not just about having a cool product or a catchy slogan
It's about having a sustainable advantage
that protects you.
from the pressures of competition.
So as investors, we need to ask ourselves,
Can this company maintain its edge? Or are they going to be stuck?
in a never-ending price war.
Exactly.
And this ties back to Buffett's overall philosophy,
Of finding companies with durable competitive advantages.
what some people call economic moats.
That's the million-dollar question.
And it's one we'll continue to explore.
As we move into the final part,
Of our deep dive,
stay tuned
we'll be right back. Okay, we're back.
for the final stretch
Of our deep dive.
into Warren Buffett's
1982 letter.
to Berkshire Hathaway shareholders.
We've talked about economic moats
The perils of stock dilution
and the importance of betting.
on the right jockey.
But there's one more layer.
We need to unpack.
It's all about context.
Remember, this letter wasn't written in some economic utopia.
1982 was a time of
High inflation
crazy interest rates.
and a recession looming.
On the horizon,
It makes you wonder how
much those external forces shaped Buffett's thinking.
especially his focus on
Conservative financial management.
He spends a good amount of time talking about
The dangers of excessive debt.
and the importance of having a strong balance sheet.
It might seem like common sense. It's a lesson that many companies
And investors,
seem to forget.
when times are good.
It's like that saying,
When the tide goes out, you see who's been swimming naked.
the companies that overextend themselves
During the boom times,
are the ones that struggle the most.
when things get tough.
Exactly.
And Buffett's approach,
It's all about weathering the storm.
he wants companies that can not only survive downturns
Yeah, but thrive.
in them.
And that brings us to another challenge.
That was front and center.
In 1982,
Inflation
the silent thief.
of purchasing power.
It's like that feeling when you go to the grocery store,
And everything is suddenly
10% more expensive.
right.
And Buffett understood
The corrosive impact,
of inflation
he knew it could eat away
at returns.
and make it much harder to build real wealth.
So what was his solution?
Invest in companies.
With pricing power,
The ability to raise prices.
without scaring away all your customers.
That sounds like a superpower.
It is.
And it's even more important today.
As we see inflation rearing its head again,
It's a reminder that you need to be thinking about
how companies will protect their margins.
in an inflationary environment.
It makes you realize that investing,
Is as much about understanding macro trends.
as it is about picking individual companies.
But let's bring it back to Buffett for a moment.
One of the things that makes these letters so enjoyable
Is his ability to weave
are like
in
small anecdotes.
and observations.
He's not just giving us
A
a...
dry economics lecture.
He's sharing his own experiences and insights.
And in this letter,
He has some particularly interesting thoughts on the nature of competition.
oh, I remember this part,
He uses the example of sugar.
to illustrate how in some industries,
Differentiation is fleeting.
he points out that no one really cares
What brand of sugar they're using?
in their coffee.
It's a commodity.
And when you're selling a commodity,
The only way to win is to be the low-cost producer
Which sounds like a recipe.
for razor-thin margins and a constant battle for market share.
It can be.
And it makes you think differently.
About what makes a company truly great.
It's not just about having a cool product.
Or a catchy slogan
It's about having a sustainable advantage.
that protects you from the pressures of competition.
So as investors, we need to ask ourselves,
Can this company maintain its edge?
or are they going to be stuck in a never-ending price war?
Exactly.
And this ties back to Buffett's overall philosophy of finding companies.
With durable, competitive advantages.
What some people call economic moats.
Now, before we wrap up,
I want to touch on one more theme.
that stood out to me in this letter.
Buffett's strong belief in shareholder rights.
He makes it very clear that companies should be run for the benefit of their owners.
Not for the personal gain of management.
He even talks about Berkshire's unique approach to corporate governance.
Emphasizing their decentralized structure.
And minimal bureaucracy.
It's all about empowering managers to make decisions.
And giving them the freedom to operate.
It sounds like he's saying, find the right people, give them the resources they need, and then get out of their way.
That's a pretty good summary.
And it's a stark contrast to the top-heavy bureaucratic structures.
You see in many large corporations.
It makes you wonder if sometimes less is more.
When it comes to corporate management,
Maybe the best way to unleash growth
is to get rid of the layers of bureaucracy.
that can stifle innovation and slow down decision-making.
It's a thought-provoking idea for sure.
And it's one of the many takeaways we can glean from this incredible letter.
So as we reach the end of our deep dive
I think it's safe to say that Warren Buffett's 1982 letter
to Berkshire Hathaway shareholders,
is more than just a historical document.
it's a timeless guide to sound business and investing principles.
The concepts he lays out are just as relevant today as they were over 4 decades ago.
They offer a framework for understanding how to build lasting value
How to navigate market volatility.
and how to align yourself with great businesses and exceptional managers.
And I think what makes this letter so powerful,
Is that it's not just a collection of abstract ideas
it's grounded in real-world examples, personal anecdotes.
and a deep understanding of human nature.
It's a reminder that investing is not just about numbers.
It's about people, principles, and the enduring power of long-term thinking.
We encourage you to read the letter yourself.
And see what insights you can glean from it.
You might be surprised at how much wisdom you can find.
In a document written over 40 years ago.
And as you navigate the complexities of today's market,
Remember Buffett's timeless advice. Focus on the fundamentals
invest in businesses you understand
and find managers who you can trust.
to act in your best interests.
That's it for this deep dive.
We hope you enjoyed it.
Until next time, keep learning, keep exploring, and keep diving deep.